There are 140,000 private companies globally with an annual revenue of over $100 million. Now compare that to just 19,000 public companies at the same revenue level. Private equity has outperformed global public equity markets in 21 of the last 22 years. Besides Amazon, that went public in 1997, 3 years after it was founded, private investors saw a 1,600 times return in Google after it went public post the 6 years of waiting. Meta has given 9,313 times return after 8 years of waiting to the private investors. And Alibaba, 13 years before IPO, delivering a 9,316 times return to those who had access. For decades, private markets were locked behind $5 million to $10 million minimums to a select few. But now that's changing. In today's video, we are going to break down what private markets are and how they have fueled billion-dollar companies before IPOs, why they have consistently outperformed public markets, and how you can access it. Welcome to Alt or Not. Let's start with the fundamentals. What exactly are private markets? At the most basic level, private investments are assets or financial instruments that are not listed on a public exchange. When you buy shares of Amazon or Tesla on the Nasdaq, you are participating in public markets. But when a venture capital fund invests directly into a startup before it even considers going public, or when a private equity firm acquires a manufacturing company to restructure it, that's private markets. Now, the private market industry has experienced tremendous growth over the last couple of decades. Large institutions were the early entrants into private markets, and they remain the leading investors today. This chart shows the explosive growth. From 2000 to 2023, private equity net asset value has grown from under $2 trillion to over $16 trillion, while public market cap has grown much more slowly. Pension funds, endowments, and foundations have allocated 10 to 20% of their entire portfolio to private markets. And they have done this for one reason: performance. Private equity consistently delivered 15 to 20% returns, while public markets bounce between -15% and positive 15%. Private credit delivers 8% to 24% returns, while public credit markets deliver 0% to 8%. Year after year after year. What this is telling you is that by the time these companies went public, the explosive wealth creation had already happened. The game was over. Retail investors got the scraps. Now you might be thinking, why would anyone accept less liquidity, less transparency, and less frequent valuations? The answer is simple. You're being compensated for taking on those constraints. That compensation is called the liquidity premium, and it shows up in the form of superior returns. So the next question is, why should you care? Between 2000 and 2010, the US stock market, the S&P 500, delivered essentially zero returns, an entire decade of stagnation. The Japanese stock market took 30 years to recover from its 1989 peak. European markets have barely outpaced inflation over the last 15 years. Even India, while it has had strong periods, there have been stretches of mediocre returns. But there's a deeper structural problem happening. Public markets are shrinking. Companies are staying private for longer. They're raising capital from private investors, scaling up, disrupting industries, and only going public when they are already mature, slow growth businesses. The problem is, for decades, that access was locked, way behind institutional barriers. But now, something fundamental is shifting. And that brings us to evergreen funds, the unlock that's democratizing private markets. These are open-ended investment vehicles with perpetual fund life. Investors can enter and exit typically on a quarterly basis. Your capital is immediately deployed into an already existing pipeline of investments. You're not waiting for years for the fund to be fully invested. This table shows you the difference. This is the democratization moment. Evergreen funds are bringing private markets to high net worths and mass affluent investors for the first time in history. The next question is, how do you actually access them? There are two primary pathways for individual investors today. Option 1. Portfolio management services. Several PMS providers now offer private market strategies. These portfolio managers don't just buy and hold, they actively work with companies to create value. Option 2. Platforms like Credibila. Credibila is one of the platforms making private markets accessible to global investors. We curate opportunities across private equity, venture capital, and private credit with lower minimums than traditional funds. We are democratizing through technology and aggregation. But remember, private markets require patience, due diligence, manager selection, and a long-term commitment. They're not a get-rich-quick scheme. They're a strategic allocation for building wealth over decades, just like the institutions do. We hope you found today's video on private markets insightful. Let me know in the comments, what concerns do you have for investing in private markets? I'll reply to each one of them. That's all from me. Until next time, bye-bye.